and I'm delighted you can all join us this morning. Beautiful, sunny April morning. Today we're going to be looking at Making Tax Digital. We have co-presenters Chris Bentley and Millie O'Hara, and no doubt you'll be hearing more from them shortly. So first of all, we have a quick update, and what we have to do is read out this disclaimer, and no doubt Chris will be following it up with his as well. The following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. So individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of their affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. Okay, just to let you know, we have plenty of other resources, so follow us on LinkedIn. We've got stuff going out there every day, Monday to Friday, so there's lots of useful information going out on there. Please follow us if you're not already doing so, so you'll get notified of stuff that's going on there. We also have our YouTube channel, and there's about 5 years worth of videos on there, so follow us on YouTube. This session is being recorded and will go up on YouTube later on today or tomorrow. So you can catch up on anything that you've missed. You see all the slides again, you can pause it, halt it, fast forward it, whatever you want to do, and you can follow us on YouTube. We're also still on X, and we also have on Spotify, because we have plenty of podcasts which we've done in the past. They're sitting on Spotify. Go to Spotify and search for Harts Accountants. We'll be on there, and we're looking to do some more later on this year as well. So that's all the way you can follow us. And the next events we have on the Thursday, the 22nd of May. Now, this might sound a bit strange coming from a firm of accountants, but we also work with some business coaches as well, on the basis that we have a look overall holistically at businesses and planning and strategy and so on. A lot of business coaches do the very intricate work, which is not something we can normally do. So we're going to be joined by Martin Alderson, who is a business coach, and he's going to be explaining how he can, say, improve the sales in your business and go into the very granular details of how we can do that. Then on the 18th of June, we have our next business club networking and lunch at the Holding Horse Hotel in Bollington. It's great for networking. You have great lunch and speakers. Go to our events page to book on. It's well worth going along. We had over 50 people on the last one, and it was a great event. So look forward to seeing you on that one as well. Just a couple of updates, and I think there's going to be a lot more on this in a moment. So we've got the national insurance changes, which are coming in very, very shortly. We've got the expensive car supplement for electric cars. So if you haven't already done your road tax for electric cars, I'm afraid you're too late, because it should have been done by 31st of March. You would have got an extra year in by updating your road tax and renewing your road tax before 31st of March. And then double cab pickups is another one. If those are people driving around in double cab pickups, then again, you need to be aware of the new rules. If you want to know more information, then please let us know, get in touch. Well, that's it from me. So I'm going to be over to Chris now, if you want to share your screen. And we can start with the main presentation, which is going to be on Making Tax Digital and a little bit on the spring statement.
Yes, thank you very much, Stephen. Today's webinar is mostly on Making Tax Digital. We thought about doing one on the spring statement, but there was very little in it from a tax perspective, or at least from an immediate tax perspective. The majority of what was in there from a tax perspective actually relates to Making Tax Digital. And that's what we're going to talk about today, not just because it was in the spring statement, but because anyone who is either a landlord or as a sole trader needs to think about this. It's going to change how you do your tax, how you do your accounts over the next 3 to 4 years. We will also cover a few reminders of things that are upcoming and things that most business owners will want to think about or should I say, if not want to think about, should be thinking about over the coming weeks and months. So I've actually just changed, you've probably noticed the slight change in the title here. For most people, you'll probably come away thinking about making tax digital as making tax problems, or possibly making tax difficult. MTD also stands for making tax difficult. We'll try and make it as easy as possible, but there's no bones about it. It is going to become more difficult. Formality's over. What was in the spring statement? As I said, very little relating to tax. There was a focus on benefits changes and spending. Yes, it's all part of the government's budget and important, but it's not something that we as accountants get involved with. The government was making announcements around their priorities, defence spending, civil service cuts, etc. But actually, the only significant tax announcement related to MTD and changes to how that's going to operate going forward. So the webinar is going to recap some of the major changes that were announced in October, the horror budget at Halloween, and then we'll move on to MTD. So at this point, I'm going to hand over to Millie to talk us through some of the things that you should be aware of.
Yeah, so just going to run through some of the major changes that are going to impact from this month for some of them and going forward into the next couple of years that you need to be aware of. So the first one, major one, was to do with employers' NICs liabilities. These are going to hit for employers from this month, and it's not affecting employees' taxes. It's just the employer NICs liability. The main thing, there's two parts to it. So the main thing was that the point at which employers' NICs becomes due on an employee's salary dropped substantially from 9,100 to 5,000 per employee. So that means that for each employee in the business, that's an extra £615 in employers' national insurance due immediately. That's the annual cost. They also increased the percentage that employers' NICs is charged at from 13.8% to 15%. So for a worker who's on £35,000 a year, that's an approximately extra cost of £300 for the year just on the increase in percentage rate. But it wasn't all bad news, because they did also increase the employment allowance quite substantially from £5,000 to £10,500, and that is an amount that comes off the employer's national insurance liability. So for a lot of small businesses, that means that then the employer's national insurance liability will be reduced to nil, or it will be reduced quite substantially. So, but for a lot of larger businesses where they've got a big workforce, then these increases to the employer's NICs, it's going to be quite substantial going forward. They also did remove the restriction for larger businesses, so a lot more companies will be eligible for the employment allowance going forward. But you need to be aware it's only if you've got more than one member of staff. So single direct companies won't be eligible for that. And then this table just indicates some of the calculations for different types of businesses at different scales, and the increase in the employer's national insurance liability. So it's going to be quite a substantial impact for this year going forwards. Also, as expected, the minimum wage did increase, so the national living wage. This just shows the percentage increase. What was quite significant, though, was the increases for the under 21s and the apprenticeship. You can see it's 16.3% and 18%. So that's quite something still important. You need to make sure that all your employees, you're meeting the national living wage and minimum wage requirements. But also you need to think about if your lower level minimum wage staff are having these significant increases, you need to think the next level up and your whole levels of staff, how are you going to manage the differential between them? Do you need to give them, the other members of staff, pay rises as well, which is obviously an additional cost? And then one of the big expected changes was to do with agricultural and business property reliefs for inheritance tax. So the main thing that happened there was that it used to be an unlimited cap for these reliefs, but now it's capped at 1 million. So the first £1 million attracts a relief at 100%, and then anything after that only gets 50% from April 2026. So from next year, that means it's an effective tax rate on death of 20% on those assets in excess of £1 million. So it's very significant. And it's still the case that trading businesses will qualify, investment companies won't, and it's going to be a big issue for farms and businesses, and it's something that you need to be aware of and thinking of planning. If it's something you're worried about, just get in touch with us and we can discuss it with you and the plan for your business.
There may well, sorry, I've just Chris button here. There may well be a lot of planning that can be done either in advance of the 5th of April 26, or it might be that there's ways of managing the exposure through redrafting wills to maximise entitlements, or managing even through insurance. There are things that can be done, but some thought is required.
Yeah. And then the big thing that happened was that defined contribution pensions were brought into the charge to inheritance tax, and this is going to be effective from April 2027. Previously, these types of pension pots that were left untouched when somebody died, they would have been left without being in the charge to inheritance tax. But now, if it's effective for any deaths after April 2027, so there's no grandfathering of pensions built up now. One of the main issues with this is that if somebody was to die post 75, then the effective tax rate on leaving this pension is 67%. This means that if you've left £100 of an untouched pension into your beneficiaries, you'd pay 40% inheritance tax on it, and then the beneficiary would have to pay their marginal rate of income tax on the drawdown afterwards. So if they were a 45% additional rate taxpayer, then they would pay that on the pot that was left to them after the inheritance tax. So it's a very, very high double rate of tax as well. It's currently undergoing consultation with both the financial advisors and the various professional bodies as to how they can implement these rules and how it will work in practice. But that is ongoing. We've not heard anything from that at the moment. It's going to be very
Can I just put in, yeah, it is going to get complicated, isn't it, Millie? Because you could have maybe 5 different pension pots, and the idea is the pension company pays the tax. So again, how's it going to work? It starts getting extremely difficult, but what it does do is it changes years of what people thought was a great inheritance tax saving by building up your pension pot. But as you say, don't rush to do anything just yet. Let's wait and see what the final outcome is. Millie, could you just move your camera down slightly, because we can only see the top of your head, or move back? That would be lovely. Thank you.
Is that better?
That's better.
Yeah, so you really need to be taking advice from financial advisors as well in regards to pension planning and what you want to do with them. It's effective from April 27, so we do still have 2 years to consider it, but it's dead important that you consider the changes and know what it means for you. There you go, right, I'm passing that to Chris now.
Thank you very much, Millie. So, a recap of the big changes coming up and what ought to be thought about in terms of tax charges and those tax problems. This spring's helping is in the guise of making tax digital. Now, some of you may already have heard of it because you've got a VAT registered business. It came into place for VAT probably about 5 or 6 years ago now. It wasn't a major change for VAT in some ways. Yes, for those who had spreadsheets or bespoke VAT returns manual, yes, it was big. But a lot of people, most people were already doing quarterly VAT returns. A lot of people already had software, so it wasn't a wholesale change. For income tax, which is where they're extending it to now, the changes will be much, much, much greater. So the starting premise is that landlords and sole traders will have to keep details of income and expenditure in MTD compatible software and provide quarterly updates to HMRC. That's similar in many ways to VAT. You do a VAT return quarterly. But actually, for these people, if you're a landlord, you do a tax return once a year. You've now got quarterly tax returns to do. The Revenue insists it's not a quarterly tax return, but I'm not sure what else you would call it. A quarterly accounts return, perhaps. You still have to update the revenue quarterly as to details of your income and expenditure. And whereas for VAT, there's just the 9 boxes on the VAT return, for income tax, you're actually going to have to give, if you're above the VAT registration threshold, a detailed profit and loss account every quarter. So spreadsheets are probably out. That said, there should be software on the market that will do most of the work. And similar to VAT, the expectation is that you'll be able to just press a button in your software and that will send the numbers down the wire to the revenue. The other thing to note is that you'll still have to do an end of year tax return. What the revenue want quarterly is just an accounts update for the moment. So you still have to do a tax return at the end of the year. So rather than once for the revenue, it'll be 5 times a year. So who's this going to affect? So starting next April, any landlord or sole trader with income over 50,000, that's turnover, so property income over 50,000 or sole traders with income over 50,000. Landlords will be brought into, From the following year, so April 27, that threshold is reduced to 30,000. And then they announced in the budget last week that from April 2028, the threshold will be reduced further to 20,000. Now, at that point, the expectation is that pretty much every landlord in the country will be in, because that requirement relates to gross income. It's not net of expenses, it's your gross rental income. And an awful lot of sole traders, even people who are doing little more than a hobby, may well have gross income at 20,000. So 3 years' time, most people who have ad hoc income are going to be caught by this. And I'm also going to say at this point that if you're both a landlord and a sole trader, you'll have to do a separate return for your landlord income and your sole trade income. So instead of 1 tax return a year, you've now got 9. So testing is starting in earnest, the revenue. I've started the testing in earnest from this month. Are there any exclusions? I'm sure all of you are hoping that you're on this list. So if you trade as a partnership, then there's currently an exclusion from MTD. I don't think they can work out how to get it to work in the short term. However, if it's just a jointly owned investment property or investment portfolio, that's not a partnership, so you will still have to do MTD. If you're acting for someone under a power of attorney, there's going to be an exemption in the short term. If you're a minister of religion, you're also going to be exempt in the short term, as are recipients of the married couples allowance. But to get that allowance, one of the couple has to have been born before 1935. So I suspect in practice, it's not going to have that wide application. There are also a number of less common, again, situations that we don't see applying very often in practice, but there will be exemptions if you've got particularly unusual circumstances. For most people, the only real exemption is likely to be the partnership one. So why is all this happening? The revenue say they're doing this to reduce the chance of taxpayers making errors in their returns and to make sure taxpayers pay the right amount of tax. And so the taxpayers have up-to-date, accurate information about the businesses. That's all very high-minded and laudable. Now, why does the revenue want taxpayers to pay the right amount of tax? Probably because they think they'll collect more. But actually, when you look at the budget's costing estimates, the amount that they think they'll raise from this is quite small. You're talking hundreds of millions. You're certainly not talking into the billions. And when the government's spending something like 1,000 billion a year, it's pretty trivial. It's small change. So there's a huge amount of extra cost coming to business and landlords. Perhaps let's think about what else might be going on there behind the scenes. Is it something to do with moving taxpayer records onto a new HMRC platform? Possibly. Is it something to do with data collection, the revenue wanting to know what's going on in a bit more detail in the economy? Quite possible. Certainly the amounts of tax are small, for someone who's earning 20,000 gross. There might also be something around tax payments, which we'll come on to in due course. So what does it mean in practice for you? It means that most landlords and sole traders will no longer be able to use a spreadsheet to keep their income and expenditure. You'll have to start keeping records in what's termed MTD compatible software. HMRC won't be providing anything free. They've confirmed that. You'll have to pay. It also means that you have to do a separate quarterly return for each business. So this is what I was saying. If you've got a sole trade and you've got property rental, it's a separate quarterly return for each one. Now, what we'd be strongly advising is that between now and when you come into this, if you haven't already done so, you open a separate bank account for each source of business or property income. The rationale for doing that is a lot of these softwares will run on a bank feed that'll run from a bank account. If you've got one bank account that's got your business income in it, your property income, and all of your personal expenditure, that is going to be really quite messy, and your software isn't going to know whether that receipt's come in from the property, from trading, whether it's a gift from your granny, whether it's something you sold on eBay. You could get into all sorts of messes. And equally, you could find yourself sending all your bar bills to the revenue by accident and then inquiring into them. So separate everything out between now and then. It'll make your life easier, but it'll also de-risk what the revenue's looking at. You're also going to have to get used to doing quarterly returns. You can't provide your records to your accountant once a year in January going forward. Now, those of you who've been with Harts for some time know that we don't like receiving records in January. It causes problems for us and it causes problems for you. I suppose the one upside of it is that people will get their tax returns done earlier because more of the information will be available earlier, and that means you'll have longer you'll know your tax bill further in advance, and if there's an issue, we'll have longer to plan around that. So the other thing to be aware of is that the quarterly update is accounting figures only, including a detailed profit and loss account if you're above the VAT registration threshold. And the figures should come directly from the software as per your VAT returns. Now that's important to note, because this will reduce the amount of hassle, for want of a better word, in there. The revenue aren't actually that interested in the figures because they're not tax numbers. You still do your tax adjustments once a year. You don't have to worry about depreciation. You don't have to worry about capital allowances. You don't have to worry about whether expenditure is disallowable on a quarterly basis. It's really, have you got your accounts and your bookkeeping up to date and put that into the revenue with a sensible classification. So don't get too caught up about every individual expense and it being a full quarterly tax return. It's not. And then the tax return itself. So as I've said, the MTD submissions are income and expenditure only. you'll have to do an update at year end to make the tax adjustments. So the bit that we as accountants have traditionally done. And that will still flow into a tax return, the filing deadline for which, for the time being at least, remains 31st of January each year. And the tax return will still include other sources of income. Now, we've not yet seen any changes to tax payment dates, although the Revenue said that they will provide an estimate of your liability based on the MTD submissions. Although, of course, there's no adjustment for tax in those, so that estimate may well be wrong if you've got anything more than the simplest of affairs. The reason I mention the tax payments yet is I think it would be prudent to assume that the government will try and bring forward tax payment dates later in Parliament once they've got this in place. They'll have the information earlier, and with the public finances in the state they are, I can well see them wanting to bring forward tax payments, which would effectively mean people get a double year's tax bill, 2 years in 1 year at some point. That's not been announced, that's pure speculation, but it's got to be a distinct possibility that that's the direction of travel. So the other side is, when MTD for VAT came in, a lot of people go, what happens if I don't do it? Well, in the short term for VAT, the answer was not very much happened. Unfortunately, that's not the case for missing MTD for income tax. There's a new late filing and late payments penalty regime, and it's very similar to that which is already in place for VAT. If you make your submissions late, you collect penalty points, and if you collect too many, they give you a fine. However, what's really difficult, where the Revenue's really going to make the money from this, is through late payment surcharges and interest. So at the moment, if you have a self-assessment tax bill and you pay it late, if you pay it within 30 days of the due date, you get charged interest at base rate plus 4. It was base rate plus 2.5 until earlier this week. It's now base rate plus 4. So 8.5% a year. And there's a 5% surcharge if it's unpaid after 30 days. Going forward, once you're into MTD, there'll be a 3% late surcharge after 15 days. That'll go up to 6% after 30 days. And on top of the ordinary interest of base rate plus 4, you'll also, from 30 days out, get charged penalty interest of an additional 10%. So you end up with an effective interest rate of 18.5% plus a 6% surcharge. So sticking your head in the sand is not really an option on this one. I suspect the Revenue will make an awful lot out of people who've done that. But we would strongly advise you, yes, you need to comply with this, get your tax return done early, and make sure you've got money in place to pay the tax arising. That said, if you are in the unfortunate circumstance that you can't pay the tax arising, then the surcharges, so the 3%, the 6%, and the penalty interest of 10% aren't levied if you make a time to pay agreement with the Revenue. So I suppose that's the carrot. We'll let you off with only charging you 8.5% interest if you get in touch with us and formally make arrangements. On top of that, the Revenue has also announced that about 10 years ago, they took powers to directly recover tax debts from people's bank accounts, only used in very limited circumstances, and they paused use of those during COVID. It's been announced in the last week that they're going to restart that. So there's definitely very much a focus on get your returns in, get it paid, and if you don't pay it, we'll cripple you with penalties and take the money anyway. That's the regime we're moving into. They're not pussycats anymore. Think of them as dinosaurs, lions, something of that order.
It certainly sounds like it's very onerous, and it's one of those, if you're not up to date, you certainly need to be getting up to date now. And, the gloves are off now, obviously, when it comes to this sort of thing. It really is pretty horrendous, to be honest.
Yeah. Some practical points. Separate registration is required for MTD for income tax submissions. So although you might be registered for self-assessments, you will have to be re-registered for MTD for income tax. This is all to do with it moving on to a new platform. So your MTD submissions will go in through, shall we call it the beta platform, whereas your self-assessment's still on the original platform. For those we act for, we can look after that. It's also the point that although the tax year runs 6th of April to 5th of April, the revenue with incredible generosity have said that you can actually use calendar quarters. So you can do your submissions to 31st of March, 30th of June, 30th of September, 31st of December instead, which is probably easier for most of us to cope with. Either way, you're going to end up with quarterly submissions by, and I've deliberately started with the 7th of August because that's the first one in the tax year. So 7th of August, 7th of November, 7th of February and 7th of May each year. If you're VAT registered as a sole trader, we'd also be advising you to change your VAT quarters so that they're also calendar quarters. So what that means is you'll do a VAT return to March, a VAT return to June, September, December, but you'll also be doing your MTD submissions to the same quarters. Now, hopefully, if you're on a mainstream software platform and you've got VAT returns and MTD quarters the same, the computer will be able to do them both in tandem and send them both to the revenue at the same time. I'm sure the software will get there, the commercial software will get there. It's getting things in line with the revenue that'll be the more difficult bit to sort out. So what's MTD compatible software? There are already lots of products available on the market. However, there was a major change announced last week that the tax return will also have to be submitted from MTD compatible software. Previously, it was just quarterly updates. At the moment, it appears that you'll be able to use different software to do the tax return as you've used for the quarterly updates. But that really was an unexpected announcement. The professional bodies have gone back and gone, why are you springing this on so late in the process? I think we'll have to see how that develops. In the short term, what we'd say is all of the major software companies already have an offering. So your Xero or your QuickBooks, as do many specialist offerings, such as Hammock, which we've been recommending for some of the landlords amongst you.
Can I just mention now that if you have got landlords, if you are landlords and you do have property income, Hammock is a great piece of software. It's something that we're rolling out to all our clients. It's relatively inexpensive. It works great for MTD and it works great for the landlord. It actually combines the best bits for both people. So as a landlord, you'll be able to get your EPC rating directly in. You'll be able to get valuations in. You'll be able to see the property, and you can do it on a property by property basis. And for us, it collates all the information direct from your bank account and produces the information for MTD and keeps a dashboard of when the last return was submitted. So at the end of the day, it's a great piece of kit and something we're looking to roll out to all our landlord clients. If you're not on it, we will be asking you to go on it. So just bear that in mind.
Yeah, that's personal landlords, isn't it?
Yes.
It doesn't work nearly so well with companies. So if you own your properties individually, Hammock is great. So they've got their offerings. They'll work for the quarterly submissions. What we don't yet know is how your Xero, your QuickBooks, your Hammocks will work with self-assessments generally, because it's a new requirement. It was only announced last week. Gut feeling is that the majority of the bigger ones will create some kind of wholesale self-assessment software. But what that will be able to cope with, how wide-ranging it will be, no one knows. we've obviously got our own tax software that we use for submitting your tax returns, and hopefully that will be able to interact with your QuickBooks, your Xeros, your Hammocks. We just don't know. We will guide you as information becomes available on that requirement. It was, as I say, something that the government sprung on the industry last week, and the professional bodies are saying, well, how are you actually expecting this to work? I can see the logic, but the software needs to be there before people can actually cooperate with it, particularly as the revenue have said that they're not doing anything themselves. So what are we doing here to help you with this? So we're testing from April 2025. There is a pilot scheme open, or from now. So we've already asked a small number of clients to join that. Sorry, did someone say something in the background there? Stephen, was that you? No. Sorry, so a small number of clients we've asked to join MTD a year early so that they can become part of the pilot. That helps us to understand how this is going to work in practice and help the rest of you. If you're interested in helping, then and being involved in the pilot, then please do get in touch, because the more that are involved from our perspective, the better, really. We're also going to be identifying those who are going to be mandated from April 26, and we'll be assisting those clients with getting set up in advance of that date. In due course, we'll identify those who are going to have to do MTD from April 2027 and from April 2028. We expect that for those who are in MTD, we'll do a submission service akin to that we do for VAT returns at the moment. However, it's an additional service, so I can't lie, there will be an additional fee for submitting each quarterly update in addition to what we charge for your personal tax return, because there is additional work for us to do there. So either you'll be able to do it from your software or we'll be able to do it, but if we're doing it, we will have to charge for that. We'll also be advising you on your software choices, particularly as more information regarding the new requirements to submit the tax return from MTD software becomes available. So just a few little things to consider at the end. So with this in mind, if you've not already done it, open a separate bank account. Start thinking about what software will I use, particularly if you're going to be mandated in April 26. Think about when you'll have to be doing MTD from. Are you going to be happy submitting quarterly updates directly from the software, the accounting updates yourself, or is that something that you want to pay Harts to do? Will still be a tax return to be done once a year, and that's when we'll make all the tax adjustments, depreciation, capital allowances, cars, disallowable expenditure, reviewing of repairs, etc. And then finally, there may be some of you out there who go, you know what, this is all too much. Do I actually use this as my prompt to sell the property, cease trading before I have to go into MTD? And then that's it for MTD. Obviously, there'd be scope for questions. I don't know, Steve, if there have been any questions sent in.
I've got something from James. If you want to unmute yourself, feel free to do so and ask a question.
Great, thanks very much for that. So I'm a landlord, as Chris and Millie know. So just to summarise what it seems like I have to do, and it might be relevant to others on the call. At the moment, I do run all my income and expense through my main current account. So I need to get onto the bank and open the second account, redirect the rental payments into the new account, switch over all the direct debits into the new account. I do keep all the records on Excel, which is nice and quick, and I fear this is going to be slower and more annoying One thing, and it's a software question for you guys who may want to answer now or offline, but I might just try and get one of the tenants to do all the data entry for me in return for a rent reduction. So I don't know with QuickBooks or Xero if it's possible to have like a sort of supplementary login where I can just get them to do all the bank rec for me in return for giving them 50 quid off a month on their rent, just to make this less painful.
So
yes.
yeah,
They can do Xero or QuickBooks. You can have up to, I think it's about 5 people to log in from anywhere. So yes, that's possible.
Yeah, and then as Chris and Millie know, I also have to do quarterly VAT returns. I heard you say that you can change the quarters if you are sole trader VAT, but to make the admin less painful, will it be possible to align limited company VAT for a different trade with the quarters for MTD for my sole trading landlordism, so that essentially I devote 4 half days to this a year and it's the same day?
Yeah, James, the MTD doesn't apply to your corporate portfolio at the moment. So this is purely the stuff you own personally.
Yeah, but I'd like to do all of my downloading of all
business interest.
Yeah, that makes sense. I just wanted to make it clear for everyone who was on the webinar that at the moment it is only for the personal held properties.
But for those of us who have to do VAT returns for something completely unrelated, and you want to spend 4 days a year doing this, not 8 days a year, is it possible to align everything so that we just block out 5 hours in our diary to do the corporate VAT return and the MTD personal return all in the same half day because we've managed to align all the dates?
Yeah, the VAT quarters for a corporate could be changed as well if you wanted it to.
Yeah. Okay.
And then I was just going to mention, you know how you said about the software and everything for the income and the expenses on the personal properties. On Hammock, what you do is you link it to the bank account and then you track in each item. So if you've got rent coming in from the same person every month, you track it once and it will then pull in all of those, so you never have to track them again. Same with outgoing expenses, mortgages, gas bills, council tax. It will recognise those once. You don't have to go in then each month or each quarter and track them. It's only going to be for one-off things, so your repairs and things like that you then have to manually go in and allocate those to where they should be. So it should be, if you get it set up in a separate bank account and you've got quite similar regular income and expenses, it should be very simple to do the bookkeeping of it. It shouldn't be too hard.
And actually what we'd say, just you mentioned the software, is for a landlord owning properties individually, we would definitely recommend Hammock over a QuickBook or Xero.
Yeah.
If you're a trader, then yes, your QuickBooks or your Xero.
Yeah. The sad news is that, of course, all of this takes more time than you're doing it in Excel, but I think that ship has sailed.
I know. And when MTD for that came in, you could still use Excel because you could use bridging software. I suspect there will be some kind of bridging software, but because the revenue is going to insist for most people on full profit and loss accounts, then your Excel spreadsheet would have to be pretty sophisticated to be able to do that.
Yeah. And just to recap, just on dates, this isn't a sort of April 25 thing coming in 3 days' time. This is earliest April 26, is that right?
April 26 is the earliest anyone's mandated. But if you wanted to join the pilots, then we would say we'll try and join from April 25 and do it for the next tax year.
The other advantage of joining early as well is if you are a landlord, it's getting used to the software as well, and making sure that it's working properly, working how you need it. It might take a month or 2 or 3 just to get all the information in that you want and get the reports out that you want, because there's a little bit of setting up to do. But once it's up and running and you get used to it, then by the time it comes in April 26, it should be a doddle.
Yeah, and there's nothing to say if your turnover or rental income is 20,000, so you're not going to be in it until 2028. There's nothing to stop you coming into it a bit earlier to get it all ordered.
Well, the good thing to do might be to actually to sort out all the admin in the background, but you don't start submitting quarterly returns until you're mandated to.
Okay. Claire, you've got a question. You want to unmute yourself? You're still on mute.
Yeah, just a quick one. I think I read somewhere that this is separate to your usual income, the rental income. Is that correct?
Effectively, yes. So I don't know what other sources of income you have, but let's say you're employed and you have rental income. You'll be doing this for your rental income, and at the end of the tax year, you'll be doing a tax return that puts together your employment income and your rental income.
Thank you.
Right, are there any further questions? I've got nothing in the chat box, just checking there. No, we've got nothing in the chat box. Anybody else got anything else they want to ask? If not, we shall close the meeting. No, that's great. Thank you very much indeed, Chris and Millie, for joining us and helping us out this morning. And thank you for all our visitors and guests who've joined us and clients to understand more about making tax digital going forward. And hopefully we shall see you on the next webinar. If not, we'll see you at the business lunch in June at the Holland Hall Hotel. Thank you very much indeed and have a great day.